Hello everybody, this is AK. I'm back. So I was taking a break from gaming and I watched a video on YouTube which I thought made a lot of sense. So I just want to share some clips from that video. I've been talking about how I'm maintaining my T-bill ladder and how it's probably a good idea to increase liquidity in our portfolio, especially when we are being paid pretty well, right? T-bills specifically, we are getting paid quite well, right? Risk-free and volatility-free. But at the same time, I say I'm also staying invested in the stock market. So it doesn't have to be either all in cash or all in stocks. It can be somewhere in the middle, right? And I think that is probably a sweet spot for me personally, right? So for the more risk averse, then probably much more in cash and less in stocks. But like I say, I don't have a crystal ball. I don't really know what is coming. So I'm just keeping more cash just in case. So many things are not in a good place in this world right now, and many things could go wrong. And if we don't have cash when Mr. Market goes into a big depression, and like I say, it's only a matter of time that Mr. Market does go into a big depression, I think we would be in pretty sad place. Right? So let's have a listen.
On the short end is going to pay you. You're not taking any risk, and you have the flex to do something different. If we get some, I don't know if we will, but if we get some real dovish language from Chair Powell next week, then all of a sudden it's off to the races and it's go time. So I think you want to have liquidity. You want to have an ability to flex and do something. But I don't think it's binary. I don't think it's cash or something else. I think it's a mixture. And we're hopeful that Powell gives us a signal that it's okay to step a little bit out on the risk spectrum.
Does dovish language from Powell next week, does that just take the Fed out of the equation for the foreseeable future because they're not going to do anything on rates? They're still going to be doing QT, but they're not going to up it. Is that what you want?
Yeah, I mean, dovish language is like nirvana. He's not saying it, right? All we can hope for is we're thinking about. Yeah. So we're prepared.
But
for
thinking about cutting, or thinking about being done.
Being done. Yeah. Well, first I thought you were going to ask me, why isn't the market up on this incredible earnings season?
I know why the market's not up. You got yields that are off to the races, right?
Yeah.
Offering, as you say, T-bill and chill.
Yep.
You got a lot of competition from yields. Plus you've got a rising dollar. Plus you've got rising oil costs.
So there you have it. I really like how the expert was quite poetic. He says T-bills and chill, right? So buy T-bills, build your T-bill ladder. You enjoy another stream of passive income, recurring income once every 2 weeks in our case, with 6 months T-bills, and just chill and enjoy the passive income. And that's also a war chest that we can dismantle, right? The T-bill ladder can be dismantled every 2 weeks in case Mr. Market does go into a depression and we have money to invest with. But of course, they also talk about why the US stock market isn't going up much more. It's not because earnings are bad or something like that. Of course, earnings are kind of under pressure because of higher interest rates, but earnings have been decent. But it's not going up. It's come down largely because of competition from yields. So I know many people have bought into the S&P 500 index as a form of investment, diversifying away from Singapore. That's not a bad idea, right? Diversification. But if we're 100% in S&P 500 and we are a bit concerned why things are not moving upwards, then we know is why, because of yield. Yield has been really strong and is strong competition for the stock market, right? So that's this short video. There's another video coming up in the usual time slot, 8 p.m. So that's going to be more substantial. So look out for that. Bye-bye.